All right, welcome to this bonus material for the Old Fashioned Real Estate Show. This is something I'm trying new. I haven't even told Brian about it, so when it gets up on YouTube, on our channel, or maybe on Facebook, he'll find out about it, and hopefully he'll be okay. So what I'm going to do today is I'm going to do a book review of a book on real estate investing that I just recently completed. This book here, I don't know if you can see that clearly or not, but what it says is what every real estate investor needs to know about cash flow and 36 other key financial measures by Frank Gallanelli. This book came recommended in a class that I was taking over at Harvard. The professor said it was a really great book, so I went ahead and I picked the book up and I bought it and I read it over the winter break, and it's really fantastic. So I'm not going to cover every single thing that's in the book, but I am going to say that if you are an investor in real estate, that you definitely want to check this book out. I have some notes. I'm going to kind of cover a couple of things that I think are important about the book, kind of underlined and highlighted some places, and I'll probably be reading this book again, honestly. But the key takeaways are what we're going to cover today. So the first one, chapter 1, I'm just going to go through it in order, I think. So chapter 1 is about the importance of doing your homework. This is preliminary due diligence. It's talking about finding and verifying that a property actually makes sense on just sort of a cursory basis. Make sure that the location looks good, that the property itself looks good, that the numbers look good, and that it actually makes sense. This is a very preliminary analysis just to see right off the bat if it actually makes sense to even look at a particular property. Chapter 2 is what he calls financial detectives. In chapter 2, he talks about sort of building an annual property data, also called an APOD scorecard, basically, where you're going to put in all of your expense figures, you're going to put in all of your income figures, and then you're going to see really what the net operating income is, and you're going to compare that. Basically, that's really what chapter 2 is about teaching you how to calculate a net operating income. So that's things like taking all of the income, whether it be rents, whether it be laundry income, storage income, or any other income that you might have, parking fees, late fees, things like that. And then reducing those down to what you expect to receive, taking out vacancy, taking out bad credit loss, things like that. And then after that, then you have a sort of income figure. That's your top line adjusted gross income. And then below that, you're going to have all of your expenses. So you're going to take out things like management fees and utility bills and whatever other expenses there might be. Pretty much everything except for taxes. And that's your tax on your profits. Property taxes obviously do come out of there, but everything other than that, and also no amortization or financing costs. So that actually comes out because that's different for every person depending on the loan terms that they get. It's really about coming up with that net operating income number, all of the expenses, and what it would look like for any investor, whether they bought it for cash or whether they bought it with 100% financing. The NOI, the net operating income, should look the same. So really that's what chapter 2 is about, is how to calculate the NOI, and then also to compare them, and what things to look for to make sure you're not missing something. So you develop a spreadsheet, and it's going to list common expenses. And then if you see a property that maybe the marketing materials don't have those expenses on there, you're going to compare that against what you expect it to be and say, is there a reason why that expense isn't on there? So that's why it's a financial detective, because you're just digging into the numbers, you're kind of comparing it against what you expect, and then you're trying to explain what the discrepancies are. And it might be they just didn't put it on. Maybe they didn't put management fees on, but that there should be some. So you're going to take the management fees off when you're coming up with what you think the net operating income should be. Chapter 3 is a really great chapter. It's real technical if you're not familiar with the concepts, but it's about time value of money. So in chapter 3, you're going to learn things about present value of future cash flows. So I think everyone knows sort of instinctively, my dog's drinking behind us, so I apologize for that, but I think everyone knows kind of instinctively that if someone says, I'll give you $100,000 today, that's really great. If they say I'll give you $100,000 2 years from now, that's also really great. But you would rather have the money today than 2 years from now. It's, in other words, the money's more valuable to you today than it would be in the future. Not that you would be disappointed to get a free $100,000 at any time, but the point is there is a value to getting something now, and we can calculate this. If we know what's called a discount rate, we know what an average investor would expect to receive for their money, we can figure that out. So just real simple, if you have a 10% discount rate, this is off the top of my head. I mean, you can do this in Excel, and you shouldn't try to do it off the top of your head, but if you have a 10% discount rate, what that's saying is, if I had $100,000 today, and I'll put it into a theoretical investment that gained 10%, I'm going to have $110,000 1 year from today. 10% return on my money. So what that means is that if I assume that I should always get 10% on my money, I'm not saying I should, but if that's the discount rate that's appropriate in this market, which it probably isn't, then $110,000 a year from now is worth the same as $100,000 today. Because if you had $100,000 today and you achieved your discount rate over a year period, you would have $110,000. And of course, the further out you go, the more that matters. You know, at 2 years, it's $121,000 because you get gains on the 10,000 as well. And those are rough numbers, but the point is that there's a function in Excel that will help you find the net present value of an asset. It's the NPV function. And that's really important. And he kind of goes through how that applies to real estate. And when you're thinking about buying real estate, this is really important, because if you get small cash flows in the beginning and you expect those cash flows to go up over time, you know, maybe you make $1,000 this year and $2,000 next and $10,000 the next. The question is, what's the net present value of $10,000 3 years from now, and how does that attribute to the value of the property that I'm buying right now? And you can compare properties by knowing the net present value of a particular deal. You can compare from one property to the other. Even though one might, you know, look like over the next 10 years it's going to make you $1 million, but this other property is only going to make you $800,000, but it's going to do it over the next 5 years. There's a very good chance that you'd be better off to make the $800,000 over the next 5 years, because the net present value of that money, if the discount rates are the same, would be higher. And then you could take that $800,000 5 years from now and invest it for 5 additional years. And so that's the time value of money, and that's really what Chapter 3 is about. There's a little bit more to that, but that's the general idea. When we move to Chapter 4, Chapter 4 was also really great. In fact, this whole book is actually really, really great. So Chapter 4 is about how to estimate what a property is worth. So once you know how net present value works, you know how to calculate an NOI, then you can start applying metrics to the property to determine what the value of the property is. So you can look at what's the net present value today of this future stream of cash flows. That's really great. That helps you determine what the value of the property is. But there are other ways to look at it too. One way is something called the cap rate, which is essentially the discount rate applied to the NOI, or the rate of return that the property gets applied to the NOI. So if a property makes $100,000 per year, and the cap rate is a 10% cap rate that you're purchasing it at, then you would know that 100,000 divided by 10% is $1 million. So that means if you bought it for $1 million, it would produce $100,000 in income, and therefore it would be a 10 cap rate. So that's essentially the capitalization rate. Well, there's a little bit more to this. If you don't know what a cap rate is, you should definitely read the book, because it'll clarify a lot of that. I can't really get into all the details of this. Video would be like, 145 minutes long instead of the already too long that it's going to be. So anyway, if you haven't read the book, do it. But then after you read Chapter 4, or really at the end of Chapter 4, there's a bunch of rule of thumbs about how to know if it's a good idea to buy a property. One thing is, if it's a property that's not worth selling, like if you're trying to look at what it would be worth if you sell it, it's probably also not worth buying. That's an interesting rule of thumb. A buyer's going to want to look at the current year NOI. The seller's going to want to look at next year's NOI. That's sort of an interesting dichotomy, because NOI tends to go up over time. So when I'm trying to sell my property, if it makes $100,000 this year, and I think it's going to make $110,000 next year, and it's a 10 cap, I'm going to say, hey, Mr. Seller or Mr. Buyer, it's going to make $110,000 next year. You're going to apply a 10 cap rate to it, so it's worth $1,100,000. And then the seller's or the buyer's going to say, no, wait a minute, Mr. Seller, like it only made $100,000 this year. If I apply a 10 cap rate to $100,000, I get $1 million, and you're trying to charge me $1.1 million. So that's an interesting rule of thumb, and I think that's really true in the market, and that's one of the sort of takeaways from chapter 4. Moving on, chapter 5, another really great chapter. Chapter 5 is about measuring the returns that you get from a real estate investment. So this is a little different than valuing it. This is looking at cash on cash return. This is looking at internal rates of return. This is looking at all those different metrics that are really about the different returns that you can get. And then really some of the problems with some of those metrics and why you really need to look at more than just one. So that's a really great chapter. Super involved. No way I could explain it in the amount of time we have. Read the chapter. You'll really enjoy it. You'll learn a lot. He also includes, which I think is really great on his website. I don't remember what the website is right now off the top of my head. But if you get the book, there's a website that you have access to as a result of having the book. And that website has all sorts of downloadable Excel forms that you can use, and you can plug some of this stuff in. So you want to know what the internal rate of return is. There's a formula in Excel that does that. He's given it to you in a format that makes it really easy. So you don't even need to know how to make the formula in Excel. You can use the IRR function. You can plug in a stream of future cash flows. It'll discount that back. You have to also plug in a discount rate, and then it will calculate what the, or you don't have to, but you can estimate the discount rate. There's a technical reason for that. But if you do all the steps, you'll get an internal rate of return. Well, he's made it so all you have to do is say, hey, I'm going to get $10,000 this year, I'm going to get $10,000 next year, I'm going to get $10,000 the year after that, and then I'm going to sell it. I'm going to collect the $10,000 in rent, plus I'm going to get $100,000 when I sell it. So then you plug in those numbers, boom, 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 spits out an internal rate of return. So if you, if you're on the lazy side, or if you just want someone to help you with putting those spreadsheets together, you can grab the book by Frank Gallanelli, and you can then you can get that. So anyway, highly recommend that. Chapter 6, the next chapter, is the end of part 1. So then when we get to part 2, I'm going to cut it really short because that's the 37 different measures that he covers in the book, and there's no way I can cover them all here. But they're all really interesting. I'm going to highlight a couple. But chapter 6 is a series of case studies where he compares apartments, mixed use, triple net deals, and then he kind of breaks down and analyzes how you would look at every different type of property and what metrics work well with industrial versus what works good with apartments. And he applies all the knowledge from chapters 1 to 5 to these case studies and sort of models it out. The key takeaway there, I think, is that commercial modeling tends to be a little bit more difficult because you have to make some vacancy assumptions that are a little bit trickier. And you also have to model individual leases. He talks about how you can get the net present value of different lease structures. This is something you really don't have to worry about in residential because typically it's going to be, a fixed to monthly rent for a period of a year and then, or whatever, 6 months, and then the lease is up. But with commercial leases, you tend to have maybe it might be $5,000 a month for the first year, and then it goes up 5% every year after that. But it also could be, $3,000 the first year, and then goes up to $5,000 the next. Or you might give 3 months of free rent on the front side. But you can model all this stuff and figure out the net present value and sort of see, which way you would prefer it, and then you can present the tenant with a couple of different options. And he gets into a technical analysis of that. That's really cool. So part 2, the second half of the book, really, it's a little bit less than half, I think. So part 2 really starts around page 142 out of it's almost exactly half. So the second half of the book is the 37 calculations that every real estate investor needs to know. Emphasis on needs, right? So that's really it, what every real estate investor needs to know. And those are really great. Starts out super basic, talking about simple interest, compound interest, the rule of 72. Then he moves into some little bit more complicated stuff, present value, gross rent multipliers, gross scheduled income. It shows you how to calculate all these in 1 or 2 page chapters. I mean, these chapters are really, really great. Because, like, I'm just opening up at random, chapter 17, net income multiplier. So what it says here is, here's what the net income multiplier means. It's the reciprocal of the capitalization rate. Pretty straightforward. That's the definition. Then he goes on to explain, I mean, in the last chapter was cap rate, so you'll know what it is. When you get to that, he goes on to explain how that all works. Then he tells you how to calculate it. He says the net income multiplier equals 1 divided by the cap rate. So now you have a formula. Well, before you learned how to calculate the cap rate, now you have how to calculate the net income multiplier. And then he tells you how you use it, and then he gives you an example, and then he tests your understanding by asking you some questions, and then he gives you the answers to those questions. So, and that's a 3-page chapter, right? So it's just 3 pages, right? It starts here, 1, 2, 3, 3.5, I guess. But all the chapters are like that, covering things like taxable income, cash flow, cash on cash return, operating expense ratios, debt service coverage ratios, break-even ratios. Some of the stuff I hadn't even heard of, and now I'm going to use it in almost all my real estate investing. Some of it, I mean, we knew and we're already using, but some of this stuff is like really advanced and fantastic book. Highly recommend it. I'm going to go ahead and put a link to the Amazon page for this book in the show notes. And it'll be an affiliate link, just a full disclosure. So if you buy it from us or from Amazon, we might get a small amount. I don't really know if we will or not, honestly, because we just set up affiliate links and we haven't ever gotten any money from it. But I think we get a small percentage of the purchase price, and we appreciate if you use our link. But otherwise, just go on Amazon and grab it, buy it, read it. And if you do read it, let me know what you think. Either in the show notes here, on the comment section, or just send us an email over on our website, oldfashionedrealestate.com, and we'll be happy to hear what you have to say about that. Also, if you think I'm crazy and the book's terrible, then tell me that too, because I like to get the feedback. And also, if you like the idea of us doing book reviews, because this is the first one we've ever done, let me know about that as well, and maybe I'll do some more. So. Great book. If you haven't read it, highly recommend it. So get the book, read it, and if you like what we're doing with the channel and with the show, please subscribe. It means a ton to us. Every subscriber helps. And maybe hit the little bell indicator so you get notices every time we put up videos. And if you haven't already, go on our Facebook page and like our Facebook page as well. It's Old Fashioned Real Estate. And you can find us on Twitter and Instagram as well. But everywhere that you use your social media, if you could follow us, like our posts, share our posts, things like that. It really means a lot to us as we grow our business. And we really want to be able to continue to offer free content to as many people as possible, because we really believe that investing in real estate has been great for us, for both Brian and myself. But we also know so many people that have benefited so much from investing in real estate. So, like I said, I hope you enjoy. Please let me know what you think. Thanks.